Today we're looking at what happened at the Fed meeting last night. What did Jerome Powell say and how did the market react? And what does the scenario look like going forward? And then today's Trading Takeout is going to be pip versus a tick. What is the actual difference between the two? As always, make sure you like this video and subscribe to the channel to ensure that you get the best market commentary, tips, and news straight to your YouTube feed every single day to make sure that you keep your trading edge. It was, in fact, a relatively eventful Fed meeting last night, especially with the reaction in equities. I'm just going to zoom in here to see if that makes it any better. So in front of you from News Corp, the guys, every single time there's a Fed meeting, they basically look at the statement and they're able to deduce what the additions are to the statement and what has been removed. So if we go through it, basically, it's suggesting from what Powell said that he thinks that there's still more to go in terms of fighting inflation. He still wants to get inflation back to the 2% target. And that is this specific bit here. So it says, in support of its goals, the committee decided to maintain the target range for the federal funds rate at 5.25% to 5.5%. Sorry, there we go. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. The committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably towards 2%. Okay, that is the key component here. That is the absolutely key component to all of this. And it is purely because although the market had priced a hold in interest rates, they did not necessarily expect Powell to be that hawkish on inflation, considering the trajectory of inflation. And if we look at stocks, this is how the stock market reacted. So this is S&P 500 cash index. When he started talking, which I believe was roughly here, okay. So we had the initial move at 7:30. No, sorry, we had the initial move at 7, and then the press conference started at 7:30. We had a run up above the initial move's high, and then a fall pretty much when he started saying the stuff at the press conference about being pretty hawkish. Effectively, the press conference starts at about 7:45. So it was pretty bearish stocks, as you can see. And I think, the big deal that we're looking at here probably comes down to the FX market, actually, with the euro now well below 1.08. It had built up a lovely range here. You can see it traded above the range, and then it came back within and tested again. But now we're well below it. And so the new range is likely to be here, as you can see. We've got this low, that low, and then it came back up and tested. But the real direction now for the euro is sub. And this is because of differences between European rates and US rates now. US rates are probably remaining quite anchored, whereas European rates are ticking down this way a little bit, purely because of the differences in economic data, I'd argue. Germany is becoming a real issue for the Eurozone. It's becoming a growth drag. And there's pending fiscal rules that are going to be introduced into the Eurozone, which should create some considerable issues, I would say. Now, looking further back at the News Corp releases, almost everyone on the committee believes it will be appropriate to reduce rates. In theory, real rates go up as inflation goes down, but can't mechanically adjust policy. Does not know where the neutral rate of interest is. So it's very interesting that they're saying this, but they haven't, expressed an interest as of yet to even think about it. And it goes on to say they need to confirm inflation is coming down sustainably to get to a place where Fed can reduce rates. Fed needs more confirmation that it's going down. So basically, we need to start getting to like that I guess, 2% level before they consider cutting. So we'll see what happens there. But the recent tick up in the oil price might suggest that that is a little bit of an issue. So we'll look at it in terms of Brent. So we had that. We just reset this chart. We had that tick up in oil just recently, towards the end of Jan. And you can see here we were trading about 76.5, traded all the way up to 84s, now trading, $4 off. So right in that midpoint, basically. If we were to get an acceleration to the upside here based on perhaps any issues kicking off further in the Middle East, constraining supply, or even perhaps a demand shift, which is kind of unlikely given the scenario globally currently with sort of demand being relatively depressed, then that could hinder the Fed's inflation goals and it could keep everything anchored a little bit higher. But I just want to now revisit something which I showed you yesterday, which was the countdown to Fed. So I'm sure we all remember this from yesterday. So the chances actually of rates being cut for March are lower than they were yesterday by about 5%, which is quite astounding, really, in my view. If we shift over to the May meeting, we can see that it gets a little stranger because the May meeting, the chances of a cut have actually increased. So there's bets being put on that May will be when the cuts are made. So that's 3 months out now. So basically a quarter out if you want to shift how a year works. So a quarter out now is when we're looking at rates being cut potentially. That is the largest signifier here. So that is what traders are betting on in interest rate markets. That's significant for us because it might give us a trajectory as to where maybe FX goes, for example. It might give us a trajectory to say, okay, leading into the May meeting, we might want to cut our euro short bets, perhaps. That is, quite a decent play, I would argue, on this. I don't think it's there yet, though, because we're still seeing accelerating poor European data, which should actually induce the ECB to want to cut a little bit faster. But they're stuck still with relatively high inflation. So it's a really, really tricky one to manage here on this trade. And it's sort of why I'd say keep position size in a little bit smaller for now. Definitely keep it smaller. Try not to be as intraday as well, because there's data that is moving all about the place, and the volatility of that data will cause whipsaws and will cause you to be caught out. But the crux of this is that May looks now to be the month at which the Fed cuts by 25 basis points again. And this is really where we should be centering our thoughts over the next couple of weeks, let's say. This data and probabilities can change all the time, though. So just watch out for that. But the next meeting is, in fact, March. So not too long ago, the 20th of March. So we don't have too long. So let's just pay attention over the next couple of weeks as to what goes on to this pricing. There's two important differences between a pip and a tick. And you might not even have heard of a tick before, but it's definitely important to know, because at one point you might end up foraying into trading futures. Now, a pip is very, very FX specific. It is the third number after the decimal point, whereas a tick is the smallest increment of a futures contract. In ES, for example, which is the S&P 500 E-mini futures contract, it moves in increments of 0.25. So a one tick change would be from 0.25 to 0.5. Whereas in FX, it would be, say, if we're looking at euro dollar, it would be, say, 1.0788. That last 8 is the number which is a pip. So understanding this is key to just adding more context into what you are looking at.